Hey everyone, welcome back to the channel. My name's Keith, I'm a financial planner, and my focus is retirement planning. Today we're tackling a question many of you have: how to invest $1 million for a secure retirement. $1 million is a fantastic starting point, but turning it into a lifetime of income requires thoughtful planning and smart investment strategies. In this video, we'll be exploring various investment options for your $1 million nest egg. We'll discuss the potential benefits and drawbacks for each approach and explore what might work best for different retirement goals. Before we jump in, don't forget to hit the like button and subscribe for more retirement tips. Investing for retirement isn't a one-size-fits-all situation. Before diving into specific options, consider these two key factors. 1. Risk tolerance. Are you comfortable with the potential ups and downs of the market, or do you prioritize capital preservation? Some people aren't comfortable with having stocks at all. And if that's the case, there's other investment vehicles you can consider that don't have the same kind of risk as the stock market, such as treasuries, municipal bonds, fixed annuities. However, these lower risk investment types typically have lower returns. So you'll need to make sure you can achieve enough growth overall to provide for your needs throughout retirement. Number 2, retirement timeline. How many years do you expect to be in retirement? A longer timeline requires more growth to overcome inflation, and there's more inherent risk if you have a longer retirement. Understanding these factors really can help us build a strong investment bridge for your golden years. Now let's explore the building blocks. Here are some popular investment vehicles for your retirement savings. Stocks can offer potentially higher long-term returns, but they also come with market volatility. The key is diversification. Consider a mix of established companies like blue chip stocks and companies with higher growth potential like growth stocks. Personally, I like companies in the United States and companies with a healthy dividend. Number 2, bonds. Bonds offer steadier returns and lower volatility than stocks. They also provide income through interest payments. However, their return may not keep pace with inflation over time, so we can explore a mix of government bonds that are safer, backed by either the federal government or state government, and corporate bonds, potentially higher yields to create a balanced approach. Number 3, mutual funds and ETFs. These offer instant diversification across various asset classes in a single investment. They also provide professional management. However, management fees can eat into your returns. Choose low-cost index funds that track broad market indices for a more hands-off approach. Number 4, alternative investments. Real estate can offer diversification and potentially higher returns, but be cautious. These are often illiquid, which is difficult to sell and access that money, and they can carry higher fees and higher risk. So only invest a smaller portion with a financial advisor's guidance. Annuities can provide guaranteed income for life, offering protection against market volatility. However, they may have surrender charges for early withdrawals and lower overall returns compared to other options. Depending on what kind of annuity you're looking at, fixed annuities, for example, can be a good source for guaranteed income, whereas variable annuities have a little bit more growth potential with also some risk. But again, with annuities, you want to look at cost, liquidity, what are the benefits that you're getting from them, and really decide if it's something that fits into the strategy. Now let's explore some potential scenarios and suitable investment mixes. First, the conservative investor. A 65-year-old with short-term time horizon may prioritize bonds, and maybe 60% bonds with about 40% stocks. And of those stocks, dividend-paying stocks, to generate income and stability for the portfolio. Second would be a moderate investor. 50-year-old with a moderate risk tolerance might consider a balance of 50% bonds, 30% alternative investments, 20% for growth and diversification. And third would be an aggressive investor, 40-year-old, let's say, with a long-term time horizon. With higher risk tolerance, they might invest heavily in stocks, maybe 70% stocks, with a mix of 20% bonds and 10% alternatives for potential higher returns. Remember, these are just examples, so if you want to learn more, click the link in the description and get connected with one of our advisors. We'd be happy to help.